Welcome to the inaugural Seaspray Making Waves podcast. Joining us today, we have Paul McGowan, the Managing Director of Seaspray Financial Services, and Danny O'Leary, CEO of Seaspray Private.
Seaspray Financial Services is a full-service brokerage. We have a business that covers from mortgages through protection, through life cover. Our advice that we give clients is based on our own research.
Alongside the full brokerage, my focus has been in investment advice and wealth management over many years.
The S&P was down nearly 20%.
Okay, right, yeah.
European markets were off about 12%. You have Irish market was down over 15%.
And within that volatility and that uncertainty, there are opportunities, and particularly our focus is sustainable, responsible investment portfolio.
From 2021, we were forecasting through our research that the situation was going to change. The whole concept of growth stocks had reached a peak.
Our view from the House would be that by 2025, we should be seeing inflationary tendencies come back to that 2 to 2.5%. That's the target.
Got some questions from some clients, so maybe fire those at you if you wouldn't mind. Yeah.
What we have seen is in reviewing our portfolios from last year, clients' portfolios have actually outperformed the performance of the indexes because of that research-driven approach we took to investing.
Right. I'm seeing huge investment going into AI, cloud, cybersecurity. It's huge in terms of since we, pandemic and when we're moving.
Thank you for joining us today for our inaugural Seaspray Making Waves podcast, brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited, trading as Seaspray Mortgages, and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast number 1.
Today, what we plan to do is to take a look at the tumultuous year that was 2022. It's one that some of us may want to forget. And then we'll take a look ahead at 2023 and what that has in store for investors. So that's the general plan for the inaugural podcast, okay? So before we do that, I think our viewers and our listeners will be keen to understand the offering that Seaspray Private and Seaspray Financial has to provide its clients, and to explain what the investment philosophy is within the company. So you might start off by giving us a sense of that, please.
Sure. Seaspray Financial Services is a full-service brokerage. We have a business that covers from mortgages through protection, through life cover. So basically a life-to-death service business. Yeah. Our advice that we give clients is based on our own research. And we have an in-house team who focus on producing daily, weekly, monthly, quarterly research. And this goes to underlie every piece of advice that we give to our clients. We have an experienced team. Some of us are up to 40 years in the business, and we try and bring that experience to play with the investment knowledge that we have on markets.
Right. Excellent. Danny?
Absolutely. And Paul and I came together just before the lockdown.
Good timing.
I suppose my experience, and no more than that, 40 years going through lots of crises in terms of markets. But we came together on the basis that alongside the full brokerage, my focus has been in investment advice and wealth management over many years, over 25, 30 years. And we felt together we could actually have a very strong offering for clients across a wide spectrum in Ireland, where they weren't getting the relationships, where they weren't getting the one-to-one investment advice. And thankfully, we've now grown to a team of 12. And our philosophy is we create investment solutions, Marty. And we are doing that and growing that, and I strongly believe over the next number of years we will be very much on that one-to-one relationship with many, many clients out into the future.
Excellent. So a very strong team, it appears, with two facets to the business. Yeah.
And I must reinforce what Paul was saying there. The research and the content that we're delivering through Oisin and Victor, they're paramount to the detail we can give to our clients. I think the last 2 years have been so important, Marty, that we've had COVID.
Yeah.
And now we've gone into a war with Ukraine and all that's coming, and we'll deal with that in a minute. But I think the critical thing is that it's that client engagement and the one-to-one conversations. It can be on the phone. It can be the Zoom calls, which I never did before, and the team calls, but we're doing things differently now in communicating and being with our clients. And an important part of that is the research content that we can actually bring to the table.
Right.
And that, I think that's a tremendous, if you like, competitive
It underpins
scenario
almost every piece of advice.
Yeah, and across both businesses, we can access direct markets and indirect markets.
Right, okay.
By direct markets, I mean we can offer full equity dealing, full bond dealing for clients through our Connects in Pershing platform. And then with our relationships with all the life companies, we can access all of the investment funds that are available internationally. And then we have, through Danny and his team, we have a whole set of structured products, which were bespoke products that are being developed for clients.
Excellent.
I think the key is the relationships and the partnerships we have with both domestically and internationally. So we have the life companies and investment houses here in Ireland, but we have those partnerships and relationships with international A-rated banks.
Okay.
It gives us a lot of choice when we're creating investment solutions.
There's a USP there, I think, isn't there? You know? So, as I said, the kickoff really is to take a look at last year. And wow, like what a year that was, you know. So almost a perfect storm, I would say, you know, where you had energy price inflation, you had the interest rate hikes, the monetary policy was up and down, you had cost of living crisis, you had geopolitics. So it is almost a perfect storm and record levels in some cases. So do you see those aspects continue to impact markets in 2023?
I think for many clients and many investors, you have to go back probably to 2008 to see the level of dislocation that we've had in markets and a totally different crisis.
Yeah.
So for me, 2022, I think I have to say this at the very start, is that there's a human cost to what's happened in 2022. And the war in Ukraine, and we have first-hand experience because Victor, who is part of our team, is from Ukraine.
Okay, right, yeah.
And he is, you know, his extended family has come back. And the support from the people of Ireland to Ukraine in terms of opening doors and the work we've done in getting goods and supplies to Ukraine. To me, that's probably been one of the highlights in terms of how, in spite of everything that's gone on, we've been able to do the good and be part of turning that around for many people in terms of that.
Yeah.
The markets have been dramatic. And I think the seeds of that, probably, Paul, were 2021. We had from the pandemic a very strong sort of supply-demand imbalance.
Yeah.
We couldn't get supplies of food, energy, all of them were in sort of that sort of crisis. The central banks were of the view that that would be transient, and the inflation, prices moving up, was going to be, sort of transient. On the February 24th, when the war started, the game changed, and we saw energy prices. And I think during the year, we saw natural gas go to 350 euros per megawatt, and we saw, oil prices, sky high, and we have the cost of living crisis. I think we're seeing a change in that, Paul, in the last few months, but it has had a dramatic effect because for the first time for many years, we've had both bond markets and equity markets both in negative territory and quite a negative year for bonds.
If you look at it, Danny, the S&P was down nearly 20%.
Okay, right, yeah.
European markets were off about 12%. You have Irish market was down over 15%. At the same time, we had a sell-off in bonds. So we had this perfect storm, as we call it, whereby if clients were invested in equities, they were losing money. If they took the switch and went into bonds, as you know, with bonds, as interest rates rise, the price changes. And so as the central banks start to push up interest rates, people start to have losses on their bonds because if they were locked in at 2% and yields are now at 3%, they've now taken a hit. So it set up it was a very bad year for investors.
Right.
But history has shown us that if you stay invested for the long term, and we are long-term investors, we're not short-term investors. So there are times when you have to set up your investment portfolios to match the situation. From 2021, we were forecasting through our research that the situation was going to change. The whole concept of growth stocks had reached a peak, and we started switching around to value stocks, which meant a switch really from the technology sectors to the more oil, gas, the more traditional areas. Now, if you had made those switches within portfolios, you actually could have seen a strong growth over the period of time, despite the fact that the headlines, like the NASDAQ, was down so far. but you could actually have seen a reasonable benefit and at least a holding position within your portfolios.
Yeah.
So what we have seen is in reviewing our portfolios from last year, clients' portfolios have actually outperformed the performance of the indexes because of that research-driven approach we took to investing.
Right. Yes.
And as we came into the end of the year, obviously inflation continues to grow, and the central banks had been pushing up interest rates initially at 0.5%, then 0.75%. Now in the last quarter, we've finally seen where the last increase was at 0.5%, and markets have suddenly started to think, oh, maybe we're coming to a peak here. We're never sure when we're going to call it, but I think when we start talking about next year, that's going to be a big element to it. You know?
Yeah.
But we do have to recognize it was a very difficult year for investors.
Very tough year for investors last year.
Yeah. And one thing I will say, one of the reasons for the way we operate, we have the structured products which Danny's team has built, and those structured products have been built to try and see through these times of volatility,
right? Yeah.
And provide a base of capital guarantee for clients and allow clients time for markets to heal so they can recover. And these things are all available. You check our website.
Right. I think the key there, Marty, is that while there's volatility, uncertainty, and there's fear, I think for many, patience is the key, in sitting tight. But there is also opportunity. And within the last 12 months, we have seen 300 rate rises across the globe. We've seen a trio of 10%, market rallies during that period of time. And within that volatility and that uncertainty, there are opportunities, and particularly our focus is sustainable, responsible investment portfolios. This is very important. So it is, in terms of medium to long term. But there are growth themes. If you take, I know the technology sector has been hit very badly, but technology is not going away. Cybersecurity, cloud, and all the different themes that are going to be with us over the next number of years. There's going to be trillions added to GDP as a result of that. So there are opportunities over the longer term, but particularly the transformation and the green transformation. The war in Ukraine has accelerated the move from fossil fuels to renewables in a manner that will bring it very much forcefully home in terms of this coming decade. We will not be relying on Putin and natural gas and oil supplies. That move is going to move very, very fast. And if I could just give an example, in the first week of January, in Ireland, the NTMA has already accumulated 3.5 billion in green bonds. These are going to be used for the purpose in terms of waste, in terms of environmental, clean transportation, all part of Ireland's climate action plan. Yes. That was oversubscribed 10 times. Wow. Okay. So there was 300 international investors with 35 billion available. So it just shows that there are going to be investments. There is a wall of money out there.
There's an appetite,
and there is an appetite in terms of 2023. So very, very tough 2022. But I think our view would be that there is positive signs. It may be a game of two halves, if I can use the sporting analogy. It may be a game of two halves.
Yeah.
I still think the first half of 2023 will be difficult, but I do believe that there will be a momentum. As Paul highlighted, I think we're coming to the peak in terms of inflation.
Yeah.
We'll highlight that in a minute.
Yeah.
But more importantly, the Fed and the central banks, the major central banks, I think we're going to be seeing a slowing down to maybe a sort of a pause by the mid-year in terms of where we are in race.
Okay.
I hope that gives a flavour.
I'm just picking up on that point that Danny made with regard to the Irish situation. A lot of people are focused at times in the media towards UK, US.
Yeah.
But Ireland has been a standout. And the big perfect example is that we have to raise, in total, we need to raise about 7 to 8 billion this year. So already in the first week of the year, the NTMA has raised over 50% of our requirement for the year. That's because we have a very low level of maturities coming up. We have a exchequer surplus of over 5 billion this year. We've strong cash flow built up in the country, because what we've actually had is, despite all of the negatives, our economy has performed extremely well. And we're looking at a situation where at the moment, you're looking at, for 2022, the ERSI has come out and has looked at what they call modified GDP, and it's still up over 8% growth.
Yeah.
Now, for next year, they're forecasting that to fall down to about 3%. But they're using the same reasons for it to fall next year as were the same reasons given at the beginning of this year, when they then had to revise up all of their numbers. And I think there's during the course of the year, a perfect example was how the Irish government dealt with the COVID situation. They came up with a total of about 11 billion of funding for the state, for people to support businesses and to support individuals. Now, when you take that in context, the UK went out and came up with a 60 billion budget, which almost crashed their country because it was all going to be borrowed.
Exactly.
The Irish 11 billion wasn't borrowed. Not a single penny of it was borrowed. In fact, when they had done it, they had estimated we'd have a 2 billion surplus. That surplus has now turned into a 5 billion surplus. So it just gives you, we're operating in a country where we have an open economy that's very strong. The multinational sector is enormous. It has a huge investment last year into the economy. That investment is still going. Our exports are really strong. 50% of the exports on the goods side come from pharmaceuticals, and 56% on the services side come from ICT.
Right.
So we have a really wide-based set of businesses in a small economy, which does give us some positive backdrops. That you're talking about recessions kicking in across Europe and the States. We might see a technical recession. A recession is when you have two negative growths. But at this moment in time, there is nobody forecasting for a negative growth GDP for Ireland.
First half, second half of the year, do you reckon?
First half might slow down.
Yeah.
I think then we'll talk about where we're going to go next year, but I think second half we'll see things pick up a bit again.
Okay.
I think it's important also that in the last 12 months, we've probably put 25 million of clients' monies through structured solutions. But we've done that with Natixis, who are a very strong A-rated bank in terms of France. And the monies that have gone into those climate change solutions, they are all, no more than the NTMA have done the green bond, they have gone into green framework where all the monies are used for renewables. So we're looking at a green transformation. I think that's going to be a key theme as we're going through the next, 2, 3, 4 years. But it just shows that for investors who are now very conscious of climate, who are very conscious of the environment and everything we're doing in terms of trying to, get to a very much a sustainable environment. I think what we're doing in terms of the themes and the choices and also getting the returns for clients, I think they're very, very strong in terms of that green on green sort of, investment ethos. And I think that's very important going forward.
Okay. I think it was Warren Buffett that might have said, which kind of fits in with what you're just saying here. He said, be greedy while others are fearful, so totally. It's that opportunistic point
and
you
that,
made,
and that is difficult because if you put clients into investments that they're not comfortable with and they can't sleep at night. I'm 40 years in terms of looking at this. You have to be able to make sure that it fits the risk profile of the client. There's no point in putting somebody into equities or anything if they cannot tolerate that. So there are different portfolios constructed to make sure that you're looking at, I can sleep at night, but I also can look at possibly the opportunities when it is in fear there is the uncertainty. Yeah. Absolutely.
Exactly. I mean, equities and bonds, they both took quite a severe hit last year. So do you think both will bounce back and will we see recovery in the S&P in the short term, medium term, long term?
I think firstly, and last year was a year where we were anti-bonds. This year, the first half of this year, we will be more positive towards going into the bond sector. Because the bond markets have probably priced in much of the upside. And from here, over the course of the next 6 months, you could start to see the markets anticipating that interest rates will have peaked out and then will start to fall. And in that situation, you'll often find the bond market moving ahead of it. Yeah. So we would look at, 10-year and 5-year bonds at this stage for investors. And when you're looking at yields in or around 3%,
Yeah.
it's starting to be attractive.
Yeah.
Remember this time last year, we were talking minus 0.5% on bonds.
That's right.
So this is a major shift. Now, the issue, of course, is inflation, because inflation eats into all returns, and no more to bond interest as well. But it's still, for the low-risk investor, for the first time in several years, they now have an option, which is an instrument which is government-backed that can give them a positive return if they hold to maturity.
Okay.
The returns may not be great, but 3% is better than negative.
I think you're seeing at the moment a slightly inverted yield curve, because the short-term rates are higher than the longer-term rates.
Yeah.
I think we see that as equalizing out during the year. And that's another sign that whatever shallow recessions, I think we're probably of the view in the House that if there are recessions in the US and maybe a little more prolonged in terms of the UK, but if there is in Europe and the US and in the developed markets, recession type scenarios and technical recessions, we believe they're going to be shallow, because we think the market has actually priced in the higher rates. We're probably looking at rates in the US at about 5.
Yeah. Okay.
We're probably looking at our own European rates at maybe 3.25 or 3. And in the UK about 4.5. I can go back to the 80s, Marty, and when I was paying for a mortgage on a house, and the interest rates were double digit.
Yes.
We coped, but we don't want to go back to that. I think price stability from the central banks is critical. And I think they're right in terms of where they've come through in terms of 2022. It's been the right. You don't want this going on and on and on. Yeah. You're talking about the vulnerable in terms of yields, in terms of 3% yield. If inflation is 5, 6, 7%, your real purchasing power is gone. Yeah. So we have to get that back down. And we have a generation now that have seen no inflation in terms of the last number of years. Yeah, some inflation is grand, and I think the central banks will live with the 2 to 3% type targets. Our view from the House would be that by 2025, we should be seeing inflationary tendencies come back to that 2 to 2.5%. That's the target. And I don't think the central banks will deviate from that position. I think what's happening, though, is that we are seeing, after the tumultuous, sort of rises that we've seen in terms of energy prices, we've had a warm winter so far, thank God. We've had energy prices that have been coming down. And I do believe that those, in terms of the next number of months, will facilitate the central banks easing a little bit, maybe going by 0.25 instead of by 0.5, and making sure then that they get to that rate by probably mid-year. Yes. Paul, in terms of that. So our House view would be that probably will support the bond element. But I think there's a huge then focus that equities, over the long term, I've always been of the view they will deliver, but I believe then we'll actually see the equity market moving. We're coming off a year where prices have been down double digit. Right. The price earnings multiple, just in terms of the values that we're looking at simply for companies, they're down, and they are trading. I'm not saying they're cheap, but they are at a value now where I do believe if earnings come in reasonably okay. And again, we've had our in-house debate in terms of, with Oisin, in terms of, are they going to be seriously hit in terms of where they are? I think they're going to come in reasonably okay. And if that is right, then I think that helps towards second half of the year in relation to equity markets moving back up.
I mean, Oisin has a really interesting and insightful chart in our 2023 outlook, which there was a Bloomberg survey that's over 130 analysts looked at it, and 70% of them were of the view that markets would recover, equity markets would recover. Absolutely. So I think that endorses what we're saying.
And it'll be a weight of money argument.
Yes,
that's correct. What they will bring to the table.
Correct.
And I think I agree with you, Danny. I think we're going to see probably earnings, quarter four earnings are probably going to be in line, if not a little bit better than expectations, because inflation is positive for corporate earnings. Like, people forget this.
Yeah.
Okay, maybe the consumer will start to slow down. And in Ireland, consumer spending has held up completely. It's actually been extremely strong in the last quarter. So, the numbers for corporates should come in reasonably healthy. early indications from some companies that have been reporting, like for example Ryanair, their most recent numbers, their guidance is they've actually raised their guidance for the year.
Yeah.
So we're seeing early signals, particularly in areas where consumer spending, that maybe things are going to be better than you might expect. And that will feed in, as Danny said, to the PEs. Then the PEs, which were at fair to slightly below fair value, will actually start to look very good value. And again, it's an opportunity then to start positioning. And it'll be about positioning. And we've covered this in our research, in our note for 2023. We've highlighted the sectors, we've highlighted the areas that we like. And, people, if clients listening are interested, just click on the website. The report is there, the detail is there. And then we have the daily note where we keep updating our view all the time on this. So it'll help feed into people's requirements in terms of their investment knowledge.
I think another key point that we're just coming into the new year now, Marty, and looking ahead, I think one of the major things that already we're seeing, China is opening its doors again after 3 years. Don't underestimate the impact that can have over the next number of months.
Yeah.
Already, when you're looking at the internal flights in the Chinese New Year holiday, millions traveling. The fact that they're going to be opening up, I think it will probably support oil prices because, as the economy opens up, it's going to have that impact. But in world trends, when we're looking at growth, I think the developed markets are probably going to be very, very sort of 0.5 to, the US ourselves, it's going to be low. But the forecast for emerging markets, Asian economies, is actually up around the 4%. And the now new forecast for China, because of the opening up, is going to be more to the 5%.
Right.
So when you look at the average across the globe, yes, we probably have technical recessions in terms of the developed economies, but for the Asia, China, and emerging markets, we could be at 5% growth. So on average, we're still of the view that there's going to be growth of around 2.5% worldwide in terms of the coming year.
In terms of currencies, do you see the dollar pulling back?
We do.
Over time?
Yeah, I think we do.
Yes,
It's a house.
Yeah, it's a house, yeah.
The bull run on the dollar has been strong. And by the way, that has supported in terms of asset prices, in terms of it's actually helped portfolios in terms of the last number. But from parity, we're probably at 107 today.
Yes, right.
So I think we're probably going to see the fact that interest rates are moving also from a European perspective and UK perspective. I do see that the dollar will probably move a little bit back in terms of weakness over the next while.
Towards 110 probably is term level.
Energy will feed into that.
And again, I think that will help growth because there's a lot of the Asian economies that a strong dollar would be hindering, the growth of it. So a little bit weaker, I think, will actually be a plus in terms of as we go through 2023.
Great.
Yeah,
excellent. Our clients are important. They're very important. I actually got some questions from some clients, so maybe fire those at you if you wouldn't mind. Yeah,
absolutely.
I'll come to you first, Danny. One client has asked, as part of our conversations before Christmas, you mentioned specific themes that should provide opportunities in the course of 2023. Where specifically do you see opportunities in the first quarter of 2023?
Okay, crystal ball game.
A nice easy one to start with.
I think one of the sectors that really got hit last year was, as Paul said, the technology sector. The NASDAQ was down 33%. And some of the big names that we all know, the Netflixes, the Alphabets, the Googles, etc., there was no hiding place. They have come down quite dramatically in terms of their prices over the last 12 months. And as I said probably earlier on, technology is not going away. I know people are some companies are letting people go, but the industry is a big industry. And I believe, they're in that sort of phase where they've taken a lot of that, they've been beaten up.
Yeah.
But I'm already seeing mergers and acquisitions at the current pricing levels. I'm seeing huge investment going into AI, cloud, cybersecurity. It's huge in terms of since we, pandemic and when we're moving. So at current valuation levels, we have been pricing a new solution, a global technology solution, that we believe over the next 1, 2, 3 years should deliver for our clients. And we've been able to price a 14% per annum coupon in relation to that. So it's a theme that we've been looking at pre-Christmas that we've now bringing to the table for Q1 in where we are. Yeah. So I do believe the technology side is one particular area that I think we believe that for clients who can look at the medium to long term, it is a part of a portfolio that we should be having a conversation with in terms of that. Our whole focus, though, as I've mentioned earlier, is that the transformation to renewables from fossil fuels to green transformation is immense. Climate change, that's a focus that we are living with day by day in Seaspray, and the team and the resources that we have and the capabilities is working with international partners to develop solutions that are green focused. They are looking at the climate, they're looking at ESG factors and bringing them in so that those companies, I believe, that are doing the right thing in reducing the carbon footprint, doing the right thing in terms of the environment, they will get rewarded. The share price will get rewarded. Yeah. And we're seeing many investors, and I take some of the major life companies in terms of that. They're major shareholders in a lot of these companies, but they're now having that input at board, at shareholder level to change a lot of the actual activities that are being undertaken in those companies to the better from a green perspective. So I do see a lot of Q1, Q2, Q3 that we're going to be looking at that as part of the
I think it's quite evident that investors have their own green agenda, and we're matching a need in the marketplace, I think, by producing our structured notes, Paul,
I have to say also before, in Ireland, 50% of our energy, our electricity last November to October was produced by renewables.
There you go.
I think that and the new if you like, connections to the grid is going to be a key focus in terms of our own Ireland climate action plan as we go forward.
From the financial services side, I have a question for you as well, Paul. Okay. Two, actually. One client is asking if we think that they should fix mortgage or stay variable.
Well, I think we're if you haven't fixed already, it may be a bit late. There are some fixed rates still available at the lower level. I think what people need to stand back and look at is, and Danny referred to it earlier, I remember when I took out my first mortgage in the end of the 1980s, I thought I was a hero, and I fixed at 10% for 3 years.
My God.
So today, when we can get fixed rates between 2 and 3%, they are phenomenal good value. Yeah. So if clients, we would tend to advise clients long-term to fix their interest rates. Where we're at the moment is that we think if you look at the ECB, there's another 0.5% going to come again over the next couple of months. So the variable rates will go up again a bit further. But a lot of the banks are still offering fixed rates below those levels. Okay. And I think for comfort, at the end of the day, you're not looking, when you're buying your home, you're not looking to play the markets. You're looking to have a fixed cost that you know every month where you're at. Yeah. So if you can fix below 3%, I would be recommending that for clients at the moment.
Okay. That's a clear call. And then just you mentioned the strength of the Irish economy and its performance. One client is asking what our views on the Irish economy going forward are, and are there particular Irish stocks that we like?
Yeah, well, as I said, we hit on the Irish economy earlier. Yeah. I think we're going to see a situation, there's a general view that there's going to be a slowdown this year, but we're not looking at recession. We're still looking at very strong household consumption. We have a very high savings number still in Ireland, which people have kind of forgotten about. The figures now are far higher than they were before the pandemic, despite the fact that we've had a pickup in spending in 2022. So I think the areas from the Irish stock market that we would look at, firstly, travel has been, people, when COVID ended, people started traveling and the numbers have continued to rise. I mentioned briefly Ryanair. They have just recently raised their guidance. They were guiding about 1.2 billion for the year. Right. They're now raising it up to about 1.42. We're looking at they've had a very strong Q3 into Christmas, and bookings were ahead of expectations. They are now talking about carrying about 168 million passengers this year. Ryanair trades on a PE of 13.5. which is slightly below its pre-pandemic level.
Okay.
We have a target price of around 19.50 to 20 euros, and it's currently bouncing around 13.50, 13.90. So we would have a strong buy preference for Ryanair. Also, the other aspect to them, their debt in March last year was 1.5 billion. Their net debt is now down below 500 million. They have fixed over 68%, I think, of their fuel is hedged out for 2023 at $68. So the cost levels they've locked in. They're still going for the low cost fares and the numbers. It's a volume game,
right?
And they're the number one in Europe. I would be strongly recommending for portfolios for the long term.
Okay.
Another one to look at is IRES, which is coming on the property side. They're the largest owner of residential property in Ireland, particularly in the Greater Dublin area. The stock is currently trading at a 35% discount to its net asset value. It's yielding almost 5.1%. And we think that they are well positioned. They have 98% occupancy. So we know all the talk about there isn't enough homes, there isn't enough houses. These guys are full. They're generating strong, steady income. Now, their average rent level is about 12% below the market average. So they have scope to grow there. And we would see a share price at the moment trading around 109, 110. We would have a price target of about 130 for those over the course of the year.
Okay.
And that's two sides of the Irish economy. One other to think about is Smurfit Kappa. Currently trading around 35. We'd have a target price of about 42.5 for it. It's yielding over 3.5%. International, one of the largest cardboard manufacturers in the world. All these goods that people offer, particularly the people buying from the Amazons of this world, everything comes packaged. The demand for their product continues to rise. So they would be three strong companies that I think we would have for investors if we want specific stocks.
Fantastic. That's great. I think to finish on that very positive note in an Irish context, it was great. So I know it was a quick 30-minute rattle through of the global economy and various issues, but I'd like to thank you both.
Thank you, Marty.
And I think the outlook and the detail is on our website with
it is. I would encourage our viewers to log on, and the detail and the analysis of market data will be in our 2023 outlook. So and there as well, if our viewers would like to subscribe. As we know, we have a suite of market updates. So
everybody welcome.
Everybody welcome. Exactly. So, guys, thank you very much. And we look forward to our next Making Waves podcast. And it's bye for now.
Lovely.
Thanks,
Marty.
Thank you.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited, trading as Seaspray Mortgages, is regulated by the Central Bank of Ireland.